Welcome back to Luke the Trader, and today we're diving into a crucial topic for anybody looking to invest their money wisely. And in this video, I'm just sharing a few critical mistakes to avoid when investing into the penny stock market. And this is for everybody, wherever you're a novice investor or just simply in the game for a long time. Staying away from these mistakes will ultimately save you a lot of trouble, a lot of money, a lot of time, and ultimately you will achieve better returns. And you might ask now, well, what are those mistakes? Well, let's get right into it. The first mistake is pre-revenue. And this is one of the biggest mistakes that I see novice investors doing. They're putting all or most of the money into stocks that are pre-revenue and have only plans for commercialization. And pre-revenue is a big contribution towards risk due to the fact that determining a suitable value for the company becomes harder, and promotion is easier to do for the company as they have an easy time in overpromising, as some of these companies don't even offer milestones or simple timelines to hold them accountable for, as it is the venture exchange, right? And furthermore, pre-revenue has high risk compared to companies being close to or at profitability, despite offering possibly the same returns, while making it easier to determine the actual value of the company. And one additional factor to consider as well is simply dilution, as let's say under the assumption that the company will deliver great returns in the future and shareholder value is still simply being destroyed towards this step, because you have to dilute. You have to, let's say, dilute at 10 cents. You have to issue 2 million stocks, a half warrant or a whole warrant. And this is just simply destroying shareholder value towards those that have been holding the stock for a longer time. And also one risk during that essential time is the question of scaling. Can they scale profitability, and will they actually deliver on their promises? The second mistake is definitely promotion. This is everything from a paid article to an interview with a media company that only wants to show their client in the best light possible. Oftentimes, promotion in the penny stock market is more than just shady. From companies that are burning $300,000 per quarter, and they're actually pre-revenue companies, just to have their name being shown somewhere to people on forums who boost up morale and sell their shares at the next best price. It is everywhere and every time. And essentially, as a new investor, one can easily fall into the trap believing that a stock is actually way better than it is. It is always best to read the financials and find out how much money is being spent on promotion, and perhaps background checks on the management to determine if those people can be trusted, as well as additionally determine if the certain options are being granted towards certain companies and what those companies are, and if those companies are actually legit or if they're just pumping, which can happen in certain instances in the venture exchange. The third mistake is being invested 100% always in the penny stock market. And this might seem like a rather small mistake, or not even a mistake to some, as they prefer the buy and hold method. But since we have those strong bearish movements and also great times of opportunities, it is always better to have some spare cash lying on the side, just to have the chance at catching the next best opportunity, or perhaps reducing downside on the portfolio. It is hard not to be invested 100% of the time, and I even sometimes make those mistakes, but it is always better to practice a certain amount of discipline and just have some spare cash lying around. But there are some exceptions, and this is certainly where timing comes into play, unlike in the blue chip market, where this isn't really important. For example, in the strong bull market from 2020 to 21 in the venture exchange, being 100% invested during that time was just the best thing you could do. I mean, there was returns everywhere, 100% there, 100% there. Everybody was making a lot of money actually. And however, after this time, well, we had a rather strong bear market, which is still holding on to some extent, especially in pre-revenue stocks. And this is to say that timing just matters in the penny stock market, and it should always be a factor to be considered, especially when change is rapid, liquidity is low, and market caps are as big as the local mom and pop shop nearby. The fourth mistake is definitely not using the tools or not using them to the full extent. And this is more something for novice investors. And one website that you can always use is setter.com for venture companies, or perhaps the Edgar database for the US side. And this just gives you all the information that you need, all the documents to analyze different companies and find out wherever they are actually worth it. You can search the financial statements, you can search the MD&A, you can look at all these different documents to determine the real value of a company. And then you have Stock Unlock to look in the, well, essentially the past, look at the financial trends. This can definitely help you to sort of, instead of just reading financial statements, which can be a bit boring sometimes, to just speed up this process. You also have stockwatch.com, which gives you L2. You can also look at different sort of things inside it, such as, for example, the management and at what companies they have been, to then analyze how those companies have performed, to then determine if this company can be trusted effectively. And this just helps you more easily navigate the market, especially for novice investors. And this is essentially the fourth mistakes and the final one. In conclusion, navigating the stock market, especially in volatile sectors of the market, such as the penny stocks market, it requires careful consideration and due diligence at all times. And by avoiding these common or not so common pitfalls, such as rushing into pre-revenue stocks, being swayed by promotion, staying fully invested at all times, or not using certain tools which are at the disposal or perhaps cost a little bit of money. By doing this, investors can protect themselves and enhance their chances of long-term success. I know it's not an easy game to play, and it requires a lot of discipline and a lot of patience, because oftentimes it just takes way longer than one might think, and critical thinking is just so important to have a chance at success. And that's it. Have a great day.